Time now for On the Radar, which is a closer look at what a money manager is watching in the markets these days. Nate Thooft is with us. He's with Manulife Investment Management. We're going to talk about the financials. I'm told we're squeezed for time, so we won't get to Asian stocks. We'll do that the next time we have the pleasure of talking to Nate, but we'll talk to him right now about why he sees opportunities in the financials. And we're talking mainly, but not exclusively, about U.S. financials, correct?
Yeah, we're definitely leaning into the U.S. financials in particular. And I would say even within the financial sector, we're leaning into more of the bank-centric or the big banks and the big regionals. And I used to say that they were cheap. They're no longer necessarily cheap, but they're not outright expensive either. We're talking about 1.3 times book value, which is a little bit above average from a historical perspective. But the broader dynamic here is this is an industry that continues to consolidate at a massive pace. Believe it or not, we used to have north of 18,000 chartered banks in the U.S. We now have less than 5,000, and that trend is still going down. So there is M&A activity, deregulation and regulation type of dynamics that we're expecting now the Trump administration should be favorable for that. We still see decent earnings potential, and we do see, with the steepening of the yield curve, with the long end of the yield curve staying up a bit higher and the short end potentially coming down with Fed cuts, that's also a positive for the banking industry. So these stocks have worked for much of the last 12 months, but we continue to expect them to work for the next 12 months as well. So this remains a decent overweight in our portfolios.
Do you expect acquisition activity in the sector? One of the big narratives coming into the Trump administration has now been overshadowed in a big way by the tariff discussion, but it was easing of regulations, particularly on this sector, and making it easier for financials to buy one another.
We're not seeing a lot of activity yet just because of the broader uncertainties around policies in general, but we think ultimately we will see more activity and we will see some of the smaller players being gobbled up by the bigger players in the industry. And we haven't seen that for much of the last few years because of sensitivities around that from a policy perspective. But we think the loosening of those policies will be a benefit for more of that activity.
And does that cast a spotlight on the smaller banks, the regionals?
It does, to an extent. The regional names, but the market knows that, so the market knows which are the likely targets. But at the same time, we do think big banks will have to pay up a bit for those deposits and for that value. So we do think the regionals probably offer the best attractive value, but I wouldn't dismiss the big banks either.
One of the realities of the smaller banks is that occasionally they blow up, as did Silicon Valley Bank, I guess, a couple of years ago now. How should investors think about that risk?
The reality is the quality of the banks and the supervision that exists these days is pretty good relative to some of the challenges we saw during the financial crisis, as an example. We do still see examples, though, like the Silicon Valley Bank, where that happened well after the financial crisis. But I wouldn't use that as a particularly large scare tactic to avoid them. I think if you're buying a basket of those names, you're probably pretty safe, particularly if you stick with the higher quality names.
That's Nate Thooft.